Have you noticed on TikTok or Instagram or whatever your social media of choice, you've been getting a lot of ads, a lot of videos, a lot of posts from your favorite BBL realtor or your cousin Edgar who just got his license that their clients are getting a magical interest rate of 3% or 2% or 4%. And you're just wondering, what the heck, man? Is this a scam? What's really going on? Naturally, you're researching online and now you found me. Well, my friends, if you're anything like me, we don't just research a topic. We hyper-focus and overanalyze and overeducate ourselves, our fellow ADHD brainers here. So today we're going to fully understand how people are actually getting these 2%, 3%, 4% rates so we can know if it's a scam or what's the catch and just really have a deeper and full understanding of what's going on here. First and foremost, let's get this out of the way. It's possible to get these low rates with a resale, but it's very difficult and too expensive. So when people are bragging or talking about these lower rates that they're getting, let's not get it twisted. They're getting it from a builder. A home builder is paying some kind of incentive to bring it down. There's two specific type of incentives that people are doing. One is going to be your temporary rate buy downs. Okay, this is where you're going to see your cousin Edgar saying that he got his client a freaking 2% interest rate or a 1% interest rate. It's not really the case. It's a temporary rate buy down. So like what they'll say is, hey, for year one, we're going to give you 1%. Year two, we're going to get a 2%. Years three, we're going to get a 3%. And then years 4 from 30, you're going to get a 4%, right? So they're going to keep bringing up, hey man, we're going to get you a 1% interest rate. That's pretty solid, right? Well, not exactly. That's not the case. So these come in multiple forms. This, what I just showed you right now, is a 3-2-1 buy down. There's also a 2-1 buy down when they only do 2 times, right? So they do this, and then they permanent buy down. And then also there's a 1-0 buy down when they only give you 1 year, right? Depending on how in demand or not in demand they are or how desperate they are to get rid of a house, you'll see builders offering different variations. The second one is going to be a permanent rate buy down. This is when they just lower your rate to like a 3.99 or something along those lines. And that's what you get for the 30 years, which is pretty sweet compared to the rates where they are now, which is like in the 6s or 7s. A lot of times a temporary rate buy down is combined with a permanent rate buy down. But what I've seen is that last rate you get from years 3 to 30 or years 4 to 30 will probably not be as low as if you just do this one. So what I've seen normally is like if you do the rate buy down, it's a 2.5, 3.5, and 4.5. Whereas if you just do a permanent rate buy down, it'll be like a 3.75 or a 3.99 along those lines. Okay, so now let's start off with what the simplest one in my opinion is, and that is the temporary rate buy down. We're going to use a simple example here. Let's just say you're buying a house for $400,000, okay? And they're giving you a 2-1 buy down. How they're going to explain it to you is in year 1, they're going to give you a 2.5% interest rate. Wow. Years 2, they're going to give you a 3.5% interest rate. And year 3, you're going to get a 4.5 interest rate. And as you continue talking to them, all they're going to do is say, hey, we're giving you a 2.5 rate. We're going to give you a 2.5. You better freaking give us a big old smooch when you're done with this because you're getting a 2.5 rate. They're not giving you a lower rate. Okay, whatever the last rate that's being quoted to you, that's what your rate's going to be for 30 years. What you're going to see instead is you're going to see a discount for year 1 on your payments. You're going to see a discount on year 2 for your payments. Okay, so what they're doing is they're simulating a lower rate. They're not giving you a lower rate. Let me give you an example of how this works. So if we're at $400,000, we're leaving all of our insurance and taxes, our down payment, and let's say we're getting for year 1 a 2.5%. Okay, so that's going to be $1,962. Year 2 is going to go up to $2,174. Years 3 and on, the actual interest rate is going to be $2,400. All right, so what's going on here is, right, you're getting that $1,962 payment for year 1, okay, which is a $438 discount monthly, which is about $52.56 in savings total after 12 months. For year 2, you're getting that simulated lower payment, $2,174, which is approximately $226 less than the actual payment, which is about $2,712. And then after year 3, we're back to being to our normal payment, which was in this case $2,400. Okay, so essentially, if you add up what you got in savings in these 2 years, that's going to be $7,968. Guess how much it costs to get a 2-1 buy down? It costs $7,968. So basically what you're doing is they're giving you money, but they cannot give it to you legally, like in a bag, right? They can't bribe you and say, buy this house, please, and we'll give you $79.68 cash. No. What they have to do is they have to find another way of giving it to you. So the first year you live in your house, what you're going to see is your monthly payment, right? You're going to see your rate being 4.5, but you're going to see a minus $438 as basically a credit. The reason why builders have to find creative ways to give you money is because there is a cap on how much money they can give you. So if they're selling that house, they need this house sold, but there's some blocks, right? There's certain things that they can or can't do. When you're purchasing any house here in this country, if you're buying through FHA, your limit on how much a seller can give you for closing costs is 6%. So if they're trying to sell their houses, something they could do, right, is just give heavy discount. Hey, everybody who buys our houses this weekend, we'll give it to you for $350, right? No, that won't work, because now other houses are trying to sell. Let's say they're trying to sell 3 houses on that block. If this one sold for $350, they can't sell these for $400 or more, right? So what they have to do is they have to find other ways to bribe you to keep you coming. Well, closing costs to purchase a house is only about $10,000, right? So they can say, hey, we'll pay your closing costs for you, but that's not really going to help. They're not legally able to pay your down payment for you. You have to cover that with your own pocket. So if they can't reduce the price, they can't give you the down payment, and they're only limited of paying your closing costs, they're going to find other ways to tempt you, right? So all this 2-1 buy down nonsense it's a very effective marketing term to just tell you, hey, we're going to give you $8,000 back spread out in 2 years. Or even if you're doing a 3-2-1 buy down, it becomes even more lucrative, because instead of $200 or $300, it's $600 to $700 off the first. So it becomes even more lucrative. But don't get it twisted. Your cousin did not buy a house with a 2% rate or a 1% rate. They're getting a 2-3-1 buy down. And my daughter's walking around behind me, carrying around some mugs. Uh-oh. She got my Luffy mug, I don't know if you ever see back there, but I have a little mug that's like a Luffy's hat and the Aces hat. So hopefully they make it by the end of the day. Now let's talk about the permanent rate buy down, which in my opinion is the preferred option, right? When you're looking at these 2-1 buy downs, you're looking at all these other things, you can just be like, okay, thank you for bribing me with an additional $9,000, which is definitely something to consider, right? Briberies help. But this is what you should be focusing on, is what is your rate permanently going to be, and how much is it going to cost you? All right, so let's understand exactly how a permanent rate buy down works. In order for us to understand this, we need to use an example of doing it on a resale, because like I said earlier, you can do a permanent or a temporary rate buy down on any house you buy, not just new builds. So right now, market rate for an FHA loan is approximately 6.3%. Okay. Conventional is going to be approximately closer to 7%. So what would it cost in this situation to bring these interest rates down to 3.99? After talking to a few lenders today, they told me on average, it's going to take approximately 4 to 5 points to get them that low for FHA, and approximately 6 to 7 points to get them to conventional. Now this 4 and the 6 number is based on really high credit. It's really rare to see it. So it's probably closer to this 5 and 7 number. By the way, this is why whenever you're talking to home builders, they're always trying to push you to go government loan. Hey, go FHA, go conventional, because it costs them a lot less to get them to that 3.99. So a lot of times you'll see with conventional, they only give you like a 4.99 or like a 5.5. They're not going to go all the way down there. For FHA, they can get you as low as the 3s and the 4s. So now, what is a point? Well, a point is simply a percent of the loan amount. So if we're buying a house for $400,000, let's say we're putting approximately $15,000 down, our loan amount is approximately $385. That means a point in this case would be $3,800. So how much is this builder paying to get this rate to 3.99? Well, if we use this math here, we get $3,800, we multiply it by 5, we get about $19,000. And for conventional, I guess they don't give you 3.99, but if you're buying a resale, it would cost you $26,000 and some change around there. So it costs them approximately $19,000. So are they actually paying that $19,000 every single time? No, they're pre-purchasing these rates in bulk, right? So when you buy things in bulk, you get them at a discount. What's that discount? I don't know. I've never seen behind the scenes. Later on, I got a little bit of a conspiracy hobby for you, so stay tuned and you'll see something, and it'll be funny how the numbers work out. But they'll tell you, well, we paid 19, we paid 20, we paid $25,000 to get this rate this cheap. And sometimes what they'll do, if the rates go up that month, they might have to cover a little bit extra to because they've already bought the rate down to a certain number, but they might have to pay extra to get that rate down. Or maybe if your credit isn't that great, you might have to cover a little bit more extra to guarantee that 3.99. So if you're buying a $400,000 new build and you're getting permanent rate buy down, you're getting that 2-1 buy down, you're getting some closing costs, how much is the builder paying all this to get you in this house? Well, we calculated it's about $19,000 to get you that rate to the FHA to 3.99. It's going to cost you, what was it like? I would think it was like $7,000 ish around there to get you that 2-1 buy down. Now, if it was a 3-2-1 buy down, it's going to go up like by another $6-7K. But anywho, we're just going to do a 2-1 buy down, which would be between $7,000 to $8,000 around there. And last but not least is that sorry, that closing cost. Now, here's the interesting part. A lot of times if you go to builders right now, they'll give you closing costs, but they'll give you like $6,000 or $5,000 or $7,000. It's always like a lower number than they actually need. Usually closing costs would be $8,000 to $10,000 around there. So, and keep that in the back of your head because it's going to be something interesting a little bit later on. But let's say they give you $6,000. After everything, they're paying almost $32,000 to get you in this house. Aw, aren't they the sweetest and nicest people? But here's the thing. We're going to get a little bit to conspiracy Javier right now. I don't like itching that part of my brain, but there's just some things that kind of make sense to me, and I want to present them to you today to kind of just see what you think. If I'm full of poo-poo, tell me in the comments I'm full of poo-poo, but it's just interesting how some of these numbers work out. So that house that they're selling for $400,000, you would think that they can cover all these like marketing costs, which are rate buy downs and all that stuff, all the incentives, right? Those basically just marketing costs if you think about it. You would think they can cover it with their margins because what happened during COVID is there's issues with supply and labor, right? So prices went up because they had to meet the demands of the supply and the labor. Well, those issues got resolved. There are no more shortages. But one thing that happened is that prices did not go back to normal. They stayed high. So I have to assume that there's enough margins there to cover that amount. And if I was just living in La La Land, I would say, well, that's the case. And they're just, really good people and they're using their margins to help the homeowners in America, right? Well, here's the thing. In a normal situation, let's say this is you and this is your representation. Let's say you're in Phoenix. So that's actually going to be me. And this is going to be you with your cool hairstyle. Cool, right? In a normal situation, we start looking at houses. But before we start looking at houses, we talk to a bank. A bank will present to us what are the terms of your mortgage based on the current market, meaning like the rates and whatnot, and the current offerings of loan products and loan types. So based on what we get from this bank and the feedback we get, it'll change how we approach the contract and then our negotiations with the seller. Well, not just the seller and their agent, right? So it'll change how we approach it because if the interest rates are too high, if it's too expensive to buy a house, then we're going to be more aggressive. This is a healthy negotiation balance here. But buyer is on their own. Lender technically is a third party. You can say they work for the buyer, but really they're a third party. The seller has their own third party. The contract is there not to support the buyer or seller, but just there as a way to negotiate. Well, when you're buying a new build, it's completely flipped. We have to erase all these because with a new build, the builder, the seller is also the lender. The seller is also the builder, and the seller, lender, and builder all create the contract. On this side belongs to them, and everything on this side is you. So the negotiation that happens is no longer happening between buyer and seller fairly. The negotiation is happening without you in the room, baby. Behind closed doors, depending on the market conditions, interest rates, whatever's going on in the world, the builder, the lender, the salespeople, everyone here gets together to find out what are the best terms and the things we have to offer in order for us to sell houses. If there's a month where they're struggling, they might lean more on the incentives. And if that's going to cost them more money, well, hey, they have to come up with the money somehow, right? They can raise the prices, they can reduce the quality of the houses they're building, or they can find another way to pay these fees. So you're not really entering into these situations as a fair negotiation. You're essentially negotiating against a brick wall, and that brick wall is whatever the builder deems that they're willing to do that month. Okay, so now here is my theory. Once again, this is complete speculation. I told you earlier, for FHA, the limit you can receive in closing costs is 6%. For conventional, the limit you can get is 6% as well, as long as you're over 10% down. If you're under 10% down, the limit's 3%. But for this case, we're just going to focus on FHA because that's what most people are doing. If you're buying that $400,000 house, and on that contract, you'll see a clause or somewhere on there that says they're giving up to 6% to help you with your closing costs, right? To help you with fees. In this case, that would be approximately $24,000. Oh, but guess what? The lender is going to charge you closing costs and closing fees. They're going to charge you for that rate buy down that they say they're giving you, right? Remember that? Well, they're charging you for it. I think they find a way to get their money back when they sell the house. So whatever they paid to get that rate cheaper, 16, 17, 18, 19, 20,000. If it's costing 19 to 20,000 for an average market rate, my guess it costs them between 15 to 18, right? So I believe that they charge you for the rate buy down when you're buying the house, that 15 to 18,000, and they're doing that by putting 6% of concessions that they're giving you during the purchase behind the scenes. Sometimes they do it outright, like where you can see it. Sometimes they don't. But I think they're ultimately getting you to pay that fee that they pay to buy the rate buy down by giving you the credit on who's really paying for it. I guess you're paying for it because you're buying the house, but they're finding a way to get their money back through the seller's concessions. The reason why I think that's the case is because whenever you get your first estimate, whenever you're buying a new build, it's always really wonky. It looks like you're paying off a big fee for the rate buy down, but it's offset by the amount of closing costs that they're giving you. So the first one gives a good indication of what it really looks like, but then after it gets cleaned up and it looks really nice and tidy. Another reason why I think that's the case is if you get 6% of this case $400,000, that's about $24K. Well, if you get $24,000, you subtract, let's say, I don't know, just $16,000. That's about $8,000, which is why they always give closing costs between $6,000 to $8,000. They don't give you the entire amount because that's what's left over after they charge you the 6%. And I guess there's really nothing wrong or illegal what they're doing, but it feels really much like a pre-negotiated deal. It feels like a frozen dinner, right? You're buying a brand new house that's been made with whatever upgrades they thought was best, and they've pre-negotiated the deal for you, so you get this really good rate and you get these good incentives, but they get to set the price. So all you have to do is just be a willing person with the decent credit and a down payment, and they're going to fit you into this frozen dinner. And there's nothing wrong with eating frozen dinner, but a lot of times it's the only route you can get a really cheap payment because a lot of these homeowners and sellers don't want to give a big giant incentive. They think it's unfair or they're wrapped up in their emotions. So if anything, I hope this video just helped explain a little better how they're doing it. So that way, if you want to maybe recreate it for a resale, you're in your power to go do that for sure if you want. So yeah, at the end of the day, your cousin Edgar and his, what did I say, BBL realtor? I don't know why I said that. When they're bragging about their super cheap 2-3% interest rate, you just know it's a frozen package that they purchased. They pre-negotiated a contract they purchased with incentives, with new builds, and got them that deal. Odds are anybody who walked in that new builder office that month that they bought a house would have gotten the same deal. It's just they decided to go for that instead of doing a resale. They're not special. It's not special. It's just what's being offered right now by home builders. So if you're going this route, I want you to be aware of this because there might be a few months or a quarter where that builder was struggling financially and maybe their superintendent that was really on top of things left, or they had to save money by reducing the quality of their laborers or their supplies, and maybe your house that you're buying is part of that 12 or 14 houses they built that are just really shoddy. A lot of people are having issues with these home builds, and it's really prevalent right now. Like on TikTok, there's a lot of TikTok inspectors that are making these videos calling out these builders, and there's a lot of problems. So I made a video going over these inspectors and overall just giving some more advice, pros and cons, and talking about the goods, the bads, and all that stuff. So I suggest you go watch that next. I do go over a little bit of what we talked about today regarding the buy downs, but more or less it's a lot more helpful tips if you're going that route.